Worley, you're looking at this one, the engineering services company, of course, with a focus on the resources sector. We know how strong that has been. So what are you anticipating, I guess, for that the work in the pipeline as far as Worley at least is concerned?
Yeah, so Worley is my buy. They had an investor day last week, which offered some good expectations for earnings into the second half of the year and finishing the financial year on a positive note. It's important to remember, though, that Worley is quite a different business to what it was even 4 years ago. It bought Jacobs Engineering in a multi-billion-dollar deal in 2018. And one of the main implications from that acquisition was that it reduced its reliance on hydrocarbons like oil and coal. Management now aiming for something like 75% of its revenue to be from sustainable based projects. So the takeaway from that, in my opinion, is that it's shaping up very well to be a winner from the energy transition that we're seeing happen, and that's going to continue to happen over the next few years. All of the sectors that it operates in are experiencing solid investment growth, and also the backdrop of higher oil prices, as you were just talking about before with your previous guest. That's all going to provide support because it still does derive a large percentage of its revenue from those oil and or hydrocarbon industries.
Yeah, it's a tricky though one, isn't it? Because just as far as perhaps investment in those carbon-based resources is obviously lower significantly now because of the shift away from oil, gas, coal. When you're talking about a longer term, that transition then, what sort of renewables are they likely to be refocused on?
Well, I believe they touched on solar, wind, those are the main ones, but it's just encouraging to see that shift and the forward thought from management to say there is a lot more, or have that eye to the future to say this is where the world is going and this is where the investment is going to be directed towards. So those renewable projects, solar, wind, hydro, all of those areas are going to see a lot more investment. We've got a lot more net zero commitments from governments locally, overseas. So as long as that's all happening, and a focus on renewable in those sectors is going to be quite, or arguably quite profitable.
Okay, so that's Worley. Let's go to your hold, Wesfarmers. It is the diversified company, a conglomerate there. We had its strategy day last
Strategy day,
week.
yeah.
We heard from the boss, Rob Scott, there, talking about the resilience of the company, I guess, particularly in the face of inflation. And I guess a lot of that would come down to what its customers do at its Bunnings stores. So how are you seeing Wesfarmers at this point?
Well, I must admit, Andrew, that I only realised this morning that you had Chris on, who on Friday, who was also talking up Wesfarmers as well. So I must say, great minds think alike. I should start by saying that it's important to put the weakness or the share price weakness of the last few months into context. If we drag out the time frame, Wesfarmers has actually managed to beat all odds by more than 6% every year for the last 5 years. So it is a business, and this is what Rob Scott was reaffirming, that offers long-term value, and it's starting to look attractive at current levels given that share price weakness. It is, as you point out, a big retailer made up a lot of different parts, but the retail division is the body of where its revenue comes from, about 79%. Bunnings makes up 50% of its revenue, Kmart another 29%. But it is important to remember that Bunnings especially has shown to be very resilient to dynamic economic environments, which we are obviously in the midst of. And one thing they went into on their strategy day was their newly established One Digital platform. And that's really only going to provide its retail segment and businesses with broader insights to help add value to those areas and those segments. And on top of that, we still have relatively solid household balance sheets, and that offers a buffer to inflation and rates. They also have very good pricing power with Bunnings especially, and exposure to lithium, healthcare, chemicals and fertilizers in their other segments. They don't make up as big a revenue component as the other retail segments, but it's really good to see an active and attractive allocation of capital towards those sustainable and long-term growth businesses.
Yeah, Tom, unfortunately, we don't have access to the share price chart there, but it is off around 14% over the past 12 months. So certainly a significant downtrend there. So you've got a hold on it. At what point would you put a buy on it?
I think, and this is probably something Chris spoke to you on Friday as well about, but when the price starts to show a bit more positive momentum, it's plateauing. Correct me if I'm wrong, I think it was about the $47, that $45 mark looked to be a bit of support. But if we start to see more of an uptick and more of that momentum and that trend improving, that's when it would turn to a buy. So it's always encouraging to see momentum swing in that more positive direction, and that normally crystallizes my buy decision.
Yeah, you're right. It's currently, we'll finish the week at 47.15, having peaked back in August last year at $66. All right, let's go to your sell then. You've got slapped a sell on Ansell. Of course, that was a significant beneficiary during the height of the pandemic with its products. So what's the future hold?
So Ansell is my sell. As you rightly point out, it was the obvious pandemic, or one of the obvious pandemic beneficiaries, but it has fallen from grace for a couple of reasons. The stock down more than 30% in the last 12 months, and there's been a lot more chatter about the risks of the company missing full year guidance, which a miss on guidance is always quite negative for a share price. And the reason behind that is inflation, and inflation biting into margins, higher raw material prices, which make up a large portion of its cost of goods sold, expected to weigh on and really bite into those margins, higher freight costs, and the possibility of weaker demand also providing headwinds there. And the main takeaway, or the main point to take away, is that as inflation lingers, as we still see it, it's quite high here and around the world. As it lingers, so too will the headwinds for Ansell, and the risks of it missing guidance also don't really offer that much of an attractive picture.